Okay, so welcome back to Trading with Market and Volume Profile course. This chapter 5 is going to be just a very quick recap where we're going to talk about the market profile definitions of what the market participants are. I already touched a little bit on this subject when we talk about the auction market theory and the how markets move, the volume and liquidity video. But basically, in market profile has market participants divided into two groups, which will help determine who is in control based on the opening and day types, which we're going to be discussing in later chapters. Different market participants have different motivations and trade on different time frames and sizes. So we have two market participants as defined by the theory regarding market profile, which is going to be short time frame traders or STF, and long time frame traders LTF, which are also known as other time frame OTF. This is all terminology that you're going to be if you read books like by Jim Dalton, this is terminology that's going to be used there. So it's important that we know all these concepts. So the short time frame traders trade usually on lower time frames, mostly day traders. This includes retail traders as well as some proprietary traders. So this is people that trade other people's money. And the short-term traders don't trade enough size to really move the markets. They trade mostly around the points of control and perceived as fair value, okay? So basically, short time frame traders are retail traders like me and you, and we are not trading enough size to really change the trend of a market. So what we are doing as traders is trying to look at what the predominant trend or change in trend is, and we're just trying to tag on to what's called the fair value and trade around these value areas. Then we have the long time frame traders, and these are the real market movers. They're not looking at low time frames. They're opening long-term positions for days, weeks, months, etc. This is going to include banks, hedge funds, and other institutions with great capital. Their positions are going to be moving the market and starting new trends. They're going to need to execute efficiently to avoid slippage and front running. Okay, front running is when traders or other institutions are going to be trying to get in front of them. So if you have a huge order resting on the book to buy thousands of contracts at a certain price, then market participants can judge piling longs orders just above that to get filled before them. So they're going to be front running them, and then they might not get the necessary size to give them an efficient fill. So they need to slowly build their positions to what we were talking about on the last video through iceberg orders, etc. Okay, so it's just important for you to understand the concepts of these two different traders, because throughout the course we're going to be referencing both of them, and it's important to understand who is going to be in control, because that is going to be how it's determined, what we can expect from that day. If we know, for example, that long time frame traders are positioning to get long right from the beginning of the session, then that's a clue for us that we should be focusing on a long only day trading session to be positioned in the with the trend with the least amount of friction and the highest risk reward, etc. Okay, so that's pretty much it for this video, and we're going to jump into the next session now.